Well, hello everybody. Hola, guten Tag. สวัสดีค่ะ你好吗到我的中国朋友们 Namaste, Aloha, Konnichiwa. For any of those of you I may have missed, hello in whatever your native tongue might be. Howdy. And let me introduce myself, please. My name is Craig Arps. I'm Vice President of Jan Arps Traders Toolbox, and I'm the author of Hawk's Scan Century Report. I'm also the developer of many of the tools we're going to talk about today, and I'm the third generation Arps trader, and I'm happy today to be sharing a little bit of time with you to show you some of the trade setups that we use every day in our trading, and some of the analysis we use to identify and trade those setups, and some of the tools that we've created to help with that analysis. Thank you for taking a little bit of time to be here, and I have quite a lot I want to cover. I have about 5 specific setups I want to show you, so I'm going to move relatively quickly. So let's get right into it. Some of the setups that I like to use in my daily trading. The ones that are my favorites are really probably not that different than many other traders. One of my most common setups that I look for are pivot divergences to help identify early entry opportunity with a low risk stop opportunity. I'm looking for the price to change direction, basically. Also, I'm looking for pullback divergences. These are also known as trend divergences, type 2 divergences, and many people don't know about those or are not as familiar with those as they are with pivot divergences, so I'll explain what those are and show you how we find them. I also like to trade a setup that is created by our Trend Exhaustion 1 tool, which identifies overbought and oversold indications by the indicator, and they provide very consistently good tradable signals. One of my favorite tradable signals is something called the Pullback 23. This is a proprietary signal, and I will go into detail about how we develop that and how we find that popular and successful setup. And then, of course, like a lot of you, I'm also looking for early entry opportunities, the opportunity to stay in the trend as long as I can by identifying the trend early. So I'll show you how I do all of these things, and we'll start with the first on the list, which is pivot divergences. Some of the tools that I need in order to identify the pivot divergences are a good oscillator. One of my favorite oscillators is the Arps Fear Greed tool, Radar 1, and I'll show you that momentarily. The Arps Price Leader, Radar 2, also makes an excellent divergence oscillator. A lot of people use stochastic, slow D oscillators, MACDs, CCIs. You can use a lot of different oscillators. Personally, for pivot divergences, I prefer the Arps Fear Greed, and I'll go into specifically why the Fear Greed indicator works particularly well for pivot divergences in just a few minutes. We also have an auto divergence finder in our toolkit, and I'll show you some examples of that shortly. First, let's just briefly review what is a pivot divergence for those of you that may not be familiar with a pivot divergence. A pivot divergence is looking for the price, a bullish pivot divergence is looking for the price to make continually lower lows. Yet, while the price is making lower lows, you're going to see the oscillator make higher lows. This is an indication that the forces that are driving the price down are losing their strength, and the price is likely to change direction. Now, a bearish pivot divergence is the same thing in reverse. You can see the price making higher highs while the corresponding peaks of the oscillator are making lower highs. This indicates that the forces driving price up excuse me, are waning, and a trend change or direction change is impending. Here's a few more examples of bullish pivot divergences. This is off of the Spider ETF from last fall. You can see again the oscillator here making higher lows while the price is making lower lows. This is a bullish pivot divergence. Again, signifies an impending change in direction to the upside. Here's another bearish pivot divergence. Looks similar to the last one we looked at. Higher highs in the price, lower highs in the oscillator, and the price changed to the downside. Here's one not too long ago. This was in May of 2012. You can see we had lower lows in the price while the Arps fear greed indicator, radar 1, showed higher lows in the oscillator. So that was a good bullish pivot divergence, and we have seen a little bit of upside since then. Now, why is the radar 1 fear greed indicator such a good divergence oscillator? Well, let me explain to you what the fear greed indicator is. The fear greed indicator, radar 1, one of our most popular tools, is a histogram that is showing us the relative strength of the buyers versus the sellers at any given time in the market. It shows us this by plotting buying strength as an upward pointing green histogram, and when the selling strength is stronger than the buying strength, it points the selling strength as a downward pointing red histogram. The length of the histogram bars helps identify the strength of the buyers and the sellers. Watching the radar 1 fear greed is somewhat akin to watching the knot or the ribbon in the middle of a tug of war, and you can say the bulls are on one side of the rope and the bears are on the other side of the rope, and they're constantly tugging against each other. And as you're watching which side of the center line that center knot on the rope is, that is showing you how much stronger the bulls are than the bears, or how much stronger the bears are than the bulls. So because the fear greed indicator is showing us something that's not related to the motion of the price, but more related to the emotion of the buyers and the sellers, it makes for an excellent divergence oscillator, because it's showing us the strength, it's showing us the sentiment behind the price moves. Because it's showing us the sentiment behind the price moves, it's also an excellent oscillator to analyze the stage of the market. And by that I'm talking about some basic technical analysis where we like to look at whether we are in a bottoming accumulation pattern, a markup pattern, whether there's a distribution pattern, whether the smart money is selling to the what I call late money, some people call dumb money, where the panic sell-off is. It shows us this, as you can see, because it shows us how strong the buyers and sellers are vis-a-vis the price. Take, for example, summer of 2010, and the price was moving down in a pretty steady downtrend. Yet you can see with each successive downward thrust of the price, the fear greed indicator showed less and less strength of the bears, until at this point this lowest low in the price showed considerably less selling than the low up here. Well, as we identified briefly ago, this is a bullish pivot divergence, and you can see, in fact, by this bar right here, which is somewhere right around in here, the bulls, the buyers, actually were stronger than the sellers at this point in the price, which is pretty early indication that the sellers have just about sold out. And once the sellers have sold out, of course, the demand is going to become greater than the supply, and the price is likely to rise, which it does. And when it gets up here to this previous high, you can see we meet resistance, and so some people sell off, take a little bit of profit. It comes up to that resistance level again, with the buyers slightly stronger than the sellers. But man, as soon as it breaks out of this resistance zone right here, boom. Look at this. Look at all the buyers that jump in at this point in time. There's just more people buying than there is contracts to buy. This is the S&P futures contract on a daily chart. You can see that the buyers really just are totally taking control. There's no strength from the sellers or the bears anywhere, even through this little pullback here. The buyers are stronger than the sellers, driving the price up, Yeah, you can see as the price goes up, the fear greed indicator is gradually weakening. You can see the strength of the buyers is gradually weakening until finally we get some profit taking up at this level. There's more selling than buying in this little pullback here. Some people think that's a buying opportunity. This thing will never end. It's just going to keep going up. Or maybe they're just short-term traders. Anyway, the buyers step back in and are finally able to make higher highs in the price. But look at this. This higher highs in the price from the previous high. Look, we have a bearish pivot divergence, lower highs in the oscillator. So we can see that the sellers are likely to take over soon. We sure would be getting out of any long position at this point in time. You can see certainly the sellers started to take control by somewhere in here, and well, let's just see what happened next. We're right here in this chart. We can see the sellers, right here in this chart, the sellers are taking control, and there's some relatively slightly stronger selling and selling, bringing the price down. A little bit more buying, but beware, because the buyers don't have any strength left at this point. This is when the Standard & Poor's devalued the dollar, and there was a panic sell-off. I mean, a lot of institutions had to sell, and so the price dropped like a rock. You can see there's nothing but selling, it going to deeper levels than we had seen since the panic of 2008 and early 2009. And now during this really volatile time, notice every time the price thrusts down to a new low, the fear greed indicator is making higher lows until finally the price makes a lower low. It tests these lows down here, makes lower lows, but look how weak the sellers are at that point in time. A clear bullish pivot divergence. You can see it on this bar right about there. The buyers step in, take control again, and start collecting contracts in order to drive the price back up again, which certainly a little profit taking here. And after this accumulation, this is the markup phase where the buyers take control again. So that's the idea behind a pivot divergence. Now let's look at the idea behind pullback divergences. And again, the tools that I need are a good oscillator for a pullback divergence. And again, the fear greed indicator is good, although for pullback divergences, type 2 trend divergences, I personally prefer the Radar 2 price leader. The stochastic slow D is another tool that a lot of people use, and again, CCIs and MACDs and other more common oscillators are used by those that have them. And again, I'll show you shortly the Arps Auto Divergence Finder, which identifies these divergences in as real a time as a divergence can be identified. So what is a pullback divergence? Well, a pullback divergence, which is also known as a type 2 divergence or a trend divergence, is a continuation of a trend. And so it's a pullback in the trend. If we're in an uptrend, a bullish pullback divergence is when you see the price making higher lows. Say you got this low here, and then we got higher lows there, but the oscillator is making lower lows. This is giving us an indication that this is a good pullback in a trend, a good opportunity to enter at the next available entry point on this trend. And I'll show you how we enter on this pullback very shortly. Here's a type 2 bearish pullback divergence. The pullback is making lower highs. There's this high, and then here's the lower high, and then we have higher highs in the oscillator. So this is a bearish pullback divergence, and we can use this case we're using the Radar 2 price leader as our oscillator, and we can use the price leader as our timing indicator to get us into this trade, and I'll show you that momentarily. But just to briefly cover it, when the fast line of this two-line oscillator crosses the slow line, that's our confirmation, our timing signal to get in. Here are some more examples of a bearish pullback divergence. We have lower highs in the price, higher highs in the oscillator. Ergo, a bearish pullback divergence. And this is a 100,000 share intraday S&P volume chart. I personally prefer to trade the S&P futures contract for a lot of reasons, and I prefer volume charts for my intraday charts, and they provide excellent pullback divergence signals like this bullish pullback divergence signal right here. See, we have higher lows in the price while we're making lower lows in the Radar 2 price leader oscillator. So let's take a look at this Radar 2 price leader oscillator that is showing us such nice pullback divergences, and I'll tell you why it's the best oscillator for this type 2 pullback divergence. The reason is because the price leader is such a sensitive and dynamic tool. It's a two-line oscillator, as you can see. It's got a fast line which crosses over and under a slow line, and it's centered on 0. And what the fast line is telling us is the acceleration or the deceleration that is being applied to the momentum of price. Now, there are a lot of oscillators that you may be familiar with out there. Momentum is one, RSI, stochastics, which are oscillators that are based on how fast is price moving up or down. And that's pretty good information. But what I really want to know is not only how fast is it moving, but what are the forces applying to that speed? Is it getting faster or is it getting slower? It's like looking at the tachometer on your sports car or your motorcycle, and you want to pass somebody on the highway, and you rev that baby up, and that tachometer is going to rev up pretty high, and it's going to rev up much more quickly than the speedometer. Well, that's what the price leader is showing us. It's showing us the forces that are acting on the speed. It's when it's going up, it's the tachometer, and when it's going down, it's like the brake that's slowing down your car. So that provides us excellent intuition into the forces that are working on price. So when you have a pullback, the tachometer or the price leader is going to rev more deeply than the price, which is why this is such a good tool for identifying divergences. When the fast line is above the 0 line, the center line, we consider this acceleration, and when it's below the 0 line, we consider this deceleration. So I promised to show you the auto divergence finder, and you can see I have the divergence finder applied to this chart, and it's using the Radar 2 price leader to identify these divergences. You can see it's identified some trend sell signals here, pullback sell signals. I drew these lines on the oscillator so you can see the corresponding higher highs in the oscillator while the price is making lower highs. It identified this pivot buy right here, a nice higher low in the oscillator with a lower low on the price. Another pivot buy here, and the divergence finder identified this pivot sell right there. Now the divergence finder is good for a lot of different oscillators. We were just looking at it on the price leader again, but here is the divergence finder applied to the Radar 1 fear greed indicator, and you can see it's identified a pivot buy right here. That's higher lows in the oscillator and some pullback sells signals here, a pullback buy, and a pivot sell. The auto divergence finder is, even though it's an Arps auto divergence finder, it is certainly not limited to Arps tools like the Radar 1 Fear Greed or the Radar 2 Price Leader. You can use it with the stochastic oscillator as well. You can see here it's using the stochastic and identifying some decent buy and sell signals, some pivot sells and pullback buy there. It's also pretty effective using MACD. You can see some MACD divergence signals. Here's a beautiful pivot sell right here where we're making lower highs in the oscillator and higher highs in the price. Another nice one, lower lows in the price, higher lows in the oscillator. So the divergence finder can use a lot of different oscillators to find divergences. Now you don't even have to have the oscillator on the chart for the divergence finder to identify the divergences. It does it on its own, saving you a lot of chart real estate. So those are the main divergence setups that I look for and how I look for them. Now, one of my other favorite setups is the trend exhaustion 1 overbought oversold setup. And the trend exhaustion 1 is a signal dot tool that is based on, again, the Radar 2 Price Leader acceleration oscillator. And let me show you how this works. Once again, you can see I have the Radar 2 Price Leader applied to the bottom of this chart. You recognize this two-line oscillator. And you can see, in this case, I have the automatic overbought and oversold, dynamic overbought, oversold lines applied to the oscillator. This is one of the new features we've added to Radar 2 in the last year. Because it's an unbounded oscillator, it has to calculate its own overbought and oversold range. And we decided it was best if it calculated that relative to what the price was doing. So we've created a dynamic overbought and oversold range so that when price is more volatile, the overbought and oversold range expands, and when it's more congesting, it comes together, it converges. And when the price crosses, when the price leader crosses out of the oversold zone, as it does here, or out of the overbought zone, as it does here, this is, like on other oscillators, often an excellent entry opportunity into a trade. So you can see, for instance, right here, the fast line crossed out of the oversold zone, and so our trend exhaustion 1 is this little signal dot based on Radar 2, and is showing me that the fast line crossed out of the oversold line right there and gave me a signal dot to buy on this bar right here. Another buy signal dot on that bar right there, a buy signal dot on this bar because of this little cross right here. You got a sell signal right there, and these happen on that bar. You don't have to wait, until 5 bars later or anything. But you can see you got a sell signal right there and a buy signal right there from our trend exhaustion 1 tool. This is really one of my favorite tools in my toolbox, based again on Radar 2. In fact, if I could only have one tool in my toolbox, it would be the Radar 2 Price Leader, because it is such a dynamic tool. I'm going to show you some other ways that I use it here momentarily. But in this case, we're talking about these overbought signals. You can see nice overbought signals here, a nice oversold buy signal there, an overbought sell signal there. So, again, another one of my favorite setups, one of my favorite signals is the Pullback 23. And to keep moving along quickly, I will show you the tools that I need to identify the Pullback 23. And really, it's just this one tool, the Arps Pullback 23 signal tool, will show me this setup in real time. But I want to show you how we come up with the setup, and we use the Arps Price Leader, Radar 2, which I've spoken quite a bit about in this presentation, and the Arps Trend Strength Index, Radar 3, which I will introduce to you shortly. First, let's look at the Pullback 23. The pullback 23 is a signal designed to identify the earliest possible entry opportunities after a pullback in a trend. So what we want to know is, what is the trend, and are we completed with our pullback in the trend or not? So you can see the pullback 23 identified this pullback in the trend, and as soon as this bar right here closed, it said this is a good entry opportunity to resume the trend, and you could get in on the next bar and resume the trend. You can see pullback 23 identified those entry opportunities from this pullback as well. Another little pullback re-entry opportunity there, some more re-entry opportunities here. So it's really good at identifying when these little pullbacks are complete and it's time to get back into the trade. Now the pullback 23, it does work in what I call congestion, which this is here. This is just sideways movement, and you'll get some pullback 23 signals in sideways movement as well. And they work, but they're most effective when you have a stronger trend. The stronger the trend, the more effective the pullback 23. So how do we identify the pullback 23? Well, as I said, we need to know the nature and strength of the trend in order to identify the pullback in the trend. And in order to identify the strength and nature of the trend, we use the Arps Radar 3 Trend Strength Index. Now the Radar 3 Trend Strength Index is a histogram that points up as it identifies bullish trend, and when the bullish trend is confirmed and strong, it points up and it's painted blue, and it points down when it's a bearish trend, and when the bearish trend is strong and confirmed, it plots pink or magenta. Now when it's pointing up yet it's pink, this identifies weakness in the uptrend. Now we don't know if that's a pullback or if that's exhaustion or the end of the trend, but we know it's not a very strong bullish trend when it's pointing up and it's weak. Conversely, when it's pointing down and it's blue, we know that the bearish trend is weakening. It's not very strong. We don't know if it's a pullback or the end of the trend, but we know that it's not very convincingly bearish while these bars are pointing down in blue. We look for the orientation of the trend when it crosses the zero line and it's pointing blue. We can identify that as a good a bullish entry opportunity. The bullish trend is confirmed, and when it crosses the zero line and it's pink, we confirm the bearish trend. Now look here, these two little spots right here, it crosses the zero line but it stays pink. Well, this is identifying very weak bullishness, and when I see something like that, when it crosses the zero line but it's pointing up but it's pink, that to me is an indication to look for a trend reversal. Definitely wouldn't enter long until these histogram bars turned blue while they're pointing up in this case. So in this way I can identify the strength of the trend. The length of the bars identifies the strength of the trend, and the color of the bars help identify the strength of the trend as well. Now when we combine this trend strength analysis with the Radar 2 price leader acceleration oscillator, then we have an effective tool to identify when to get in after the pullback of the trend. Now I mentioned just briefly how one way to use the Radar 2 is as a timing indicator, and in fact it is my most common timing indicator to confirm when to get in or out of a trade. And the way we identify that is when the fast line crosses the slow line. That's your first indication that the price is accelerating or decelerating and moving in the opposite direction from where it has been moving. So for instance, when we see this weakness in the bullish trend identified by these upward pointing pink bars in the Radar 3, and we see Radar 2 fast line cross over, wait for it, over the slow line right there, that's our pullback 23 entry opportunity, and we got that right there on this bar. You can see we had a kind of a double kiss here. Again, weak pullback, weak bullish trend, and the fast line crosses over the slow line, for that first pullback 23 bar, comes back one more time, crosses the slow line again for the second pullback 23. Here you can see a nice bearish one. In fact, this one I really like because it's combined with this bearish pivot divergence. Note the lower highs in the oscillator right here while the price is making higher highs. We see that kind of bearish pivot divergence. Now we see the weakness in the bearish trend by the blue histogram bars pointing down. Oh, we're salivating. Wait for it, licking our chops. Wait. Boom, right there. Fast line crosses the slow line right there on that bar. Time to enter short, and we can exit the trade when the fast line crosses back over the slow line right there for a nice little profit. Again, we have bullish trend here. We identify the weakness in the bullish trend by the bars turning pink and getting shorter, and we can see the pullback 23 coming around. Here it is. Bam! Right there, right on that bar. Time to enter long right there. Resume the trend on that bar. Pullback 23. A few more examples. Pullback 23 here. Here's another one right there. A few more. You can see when the trend is not as strong, it's kind of trying to identify what direction the trend is. Note that it crossed the zero and started out pink, so those pullback 23s are not quite as reliable to me as ones like this one here, which is actually a pullback in the trend, or this one right here, which is a bearish pullback 23. Okay, now we have another trade that is even more exciting to me, and it combines the signal dots from the last two tools that I just showed you. It uses the pullback 23 in combination with the trend exhaustion 1, and I call this trade the trend exhaustion 123. Now, what is trend exhaustion 123? Well, what it is, it's the rare occasion when you get a pullback 23 and an overbought or oversold signal on the same bar, or just one or two bars apart. And the reason this is such a nice trade is because when you get this overbought signal right here in the Radar 2 price leader, that means that the price leader is making some pretty high highs. So if you're in a downtrend and you get these higher highs in the oscillator, while you're making lower highs because you're in a downtrend in the price, what do you have? It's a pullback divergence. So when you see an overbought signal combined with a pullback 23, it will almost always be identifying a pullback divergence at the same time. And so this is a really good entry opportunity for a pullback 123 is what I call that. And you can see here the oscillator is making higher highs while price is making lower highs. Oscillator crosses out of the overbought zone, and we have weakness in the Radar 3. We get the pullback 23. Nice signal to enter short. Here's another pullback 23. Here's another here's some pullback 23s, and those are okay signals. This is kind of the beginning of the trend here. But here, the pullback 23 and the overbought 1, you can see I don't have the oscillators on here, but it's clearly a nice pullback opportunity in this downtrend. Here's another one. This is a daily chart of Goodyear Tire, and this gives us an excellent entry opportunity to make a quick profit in just a couple of days. Now, before I get on to the early entry setups and how I identify early trend entry, I want to take just a minute to talk about stop losses and exit signals. And every trade is easy to get into, really. I mean, you can get into any trade in any direction just by pushing a button. The real money is made or lost in how you exit the trade. So I want some really good exit signals, and I use two different types of exit signals. I use a trailing stop, and oh, look at it trail. Ooh, there she goes. And I also like to look for discretionary exits by identifying the acceleration or deceleration of the price. In other words, using, you guessed it, the Trend Exhaustion 1 tool or the Radar 2 price leader. Let's talk about the Radar 2 price leader one more time as far as our exits are concerned. Now, I've mentioned several times that we use a cross of the fast and slow lines to time our entries and exits. Now, we're not going to trade every time they cross. We would be trading all the time, and we would probably lose money just because you can see that it crosses, especially in a situation like this, a lot of times. But what we're looking for is confirmed trade signals, and then we time our entries with the fast slow cross of the price leader. So for instance, here we see this beautiful pivot divergence where the oscillator is making higher lows, the price is making lower lows. We say, oh, there's a bullish pivot divergence, let's get in long. And as soon as the fast line crosses the slow line on that bar right there, we enter, and if we're in for just a short profit, we get out when the fast line crosses the slow line again right here. And it got a little bit of profit. Not a big profit, but a little bit of profit on that one. Now you can see we're kind of in a downtrend here, so that's a counter trend trade anyway. But look what happens here. We have a bearish pivot divergence forming in the oscillator again. Lower highs in the oscillator, higher highs in the price. Wait for it, right there. The fast line crosses the slow line. It's time to get in short. That's right about here, I would say. You sell short, and that's good because we're in the downtrend. We really like the short selling better in the downtrend than the buying of the downtrend. We stay in the trade until the fast line crosses the slow line on this bar right here and make a nice, neat little profit. We don't get any trade signals here, so we're waiting for the next signal, and we identify lower lows in the price here, higher lows in the oscillator. Again, a bullish pivot divergence, so we're looking for the fast line to cross the slow line. Boom, right there. That is, I think, on this first bar right here of that low, it's telling us it's time to enter long, and I get our quick profit right somewhere right around here. However, if you're going with the direction of the trend, and you can see that we see this bullish divergence, and I'll show you, this is where trailing stops help. You could use a trailing stop to keep you in this trend until the acceleration oscillator actually starts decelerating by crossing over zero, in which case you would exit a little further up somewhere around here. Here's another bullish pivot divergence right here. You could enter on this bar right about there. A few more timing signals. You can see this time using signals from the auto divergence indicator. The divergence indicator, and I don't know what oscillator the divergence indicator was set on here, but it identified a trend sell. So once it identified that, my price leader fast line crossed the slow line on that bar right there. So we sell short, we stay in until the fast line crosses out of the over the slow line on that bar right there, make a nice little profit. If we'd have waited till it crossed over the zero line, it would have been this bar. Still would have had a profit, but ended up giving some back if we did that. Here's another bullish pivot divergence right here. So we enter when the fast line crosses the slow line. That's that bar. We can stay in until the fast line crosses the slow line on this bar. And now we're looking for another signal, or again, we could wait until it crosses below the zero line on that bar. We'll finally get a pivot sell way up here, and on this bar right there, it's our entry opportunity. When the fast line crosses below the slow line, we sell short, and on this bar right here, we cover that short position. So we made a nice little profit. On this one, we get a trend buy, and that is somewhere right around here, but we are already above the price leader, is already above, we don't really get a good crossing opportunity there, so we have to wait for another signal. And there we get a trend buy right there. So we're looking for the radar 2 price leader to cross fast over the slow right there. We can enter long on that bar. So getting in early and quickly is really one of the most important ways of guaranteeing that you're, one, going to have a low risk entry opportunity, and two, that you can maximize your opportunity to get as much out of a trending market as possible. A few more examples, this time using entry with the trend exhaustion 1 overbought oversold signals. You can see we enter long there and would exit our position on that bar right there. This is an oversold entry, and this is an overbought entry, and this is your sell to exit that position right there on that. Hopefully you reversed that position. Oversold entry, exit on that bar right there. Okay, let's go to trailing stops. Now this is going to help us stay in the trade a little bit longer now. You can see I have the Arps trender, one of our most famous and popular tools. This tool has been around for over 20 years. In fact, it's one of the tools that inspired us to go into business. My dad, Jan Arps, invented the Arps trender in the early 90s and was showing it to some of his trading buddies, and everybody wanted one because it's such a great trailing stop. And so he started selling it to them, and before you know it, different trading platforms were asking for it, and different professional traders, hedge fund managers were asking for it. And here's what it is. It's a volatility based line which follows the price as it's moving in the orientation of the trend. Now you can see right here again, I'm looking at a 100,000 share intraday volume chart, and I have an Arps trender applied to it, and eventually the price crosses the trender on this bar right here, and the trender flips to the other side, and eventually the price crosses the trender and the trender flips to the other side. So the trender is always identifying either bullish or bearish. It doesn't really by itself identify a sideways market. It's either above or below the price. Now the trender has a sensitivity setting, and here we have it set at a sensitivity of 4, and you can see this is a pretty quick chart, 500 tick intraday S&P chart, and the trender again follows price nicely. Right here the price crossed but did not close across the trender. And this is another setup I'm not even going to talk about today, but one that we like to trade sometimes, called the trender pullback, because it allows for a low risk entry opportunity in a trend when you see the price cross but not close across the trender. You can see finally it closed across the trender flipped. I got another trender pullback right there. Finally it closes across the trender, and eventually the trender flips to the sell side and follows the price on down. Now the trender has a sensitivity setting. The one we just looked at was set at a sensitivity setting of 4. In this case, on this chart, it's set at 1, which is more sensitive. So the lower the number of the sensitivity setting, the more sensitive the trender. You can see it's following much more closely the price, which is really kind of showing us a shorter term orientation of the trend, whereas this is a near-term indication of the trend, let's say, and the price crosses it again, crosses it again. So the more sensitive the trender, the more often it's going to get crossed and flipped. Conversely, if you use a larger number for the setting, it's looking at the trend from more of a macro perspective. It's more of a long-term trend orientation, and you see it's staying a little further away from price, doesn't get crossed out nearly as much, and finally does get crossed, and the trender flips to the other side of the price. And here it follows nicely as the price goes down. So how can we identify the earliest possible entry opportunities to get into a trend and ride it for everything that it's worth? Well, the tools we need for that are a version of the trender, which I just showed you the trender set on 3 different sensitivity settings. Well, we created a tool that will do that automatically, and we call it the triple trender. It's basically just the trender set at 3 different sensitivity settings. We can combine that with the Radar 3 Trend Strength tool, which I talked to you about earlier. And we have some wave counts tools, which I'll show you, which also help us orient our entry opportunities to the earlier wave counts to help identify the earliest possible entry opportunities. And we can, of course, use the Divergence Finder in conjunction with these other tools to help us identify the earliest possible opportunities to get into a trend. So, the triple trender, as I mentioned earlier, is the trender, which we were just looking at, applied to a price chart 3 times at once. And what this does for us then is it allows us to look at the orientation of the trend from 3 different resolutions, 3 different time settings, all at the same time. So we have the shorter term trend, which is following price really closely. We have the medium term trend, which is medium. And we have the longer term trend, which stays further away from price, showing us more of the macro orientation of the trend. Now this is on a very fast chart, so again, this is an intraday 500 tick chart, which is one of my preferred day trading charts. So the triple trender here shows us the trend in 3 time frames, and one of the ways we like to use it to help in our trading is we look for all 3 trenders to come into alignment, as it happens here. And ideally we look for a good entry opportunity. I like to look for a pullback into the short-term trender after they come into alignment, and we can enter and stay in the trade until the short-term trender is broken right there. During this pullback, depending on our trading style, you either stay out or you can make the medium or long-term trender your stop loss. At any rate, you can enter again when all 3 trenders are in orientation, and again maybe exit 1 contract at the first trender break, exit the rest of your contracts at the second trender break or the long-term trender break. You can see here where the trenders are not in alignment. There's some above, some below. It's not trending. We don't even trade when it looks like that. Here we have all 3 bearish, and here we have all 3 bullish, and so you could trade those, but I'll show you how I will filter those out and stay out of this mess. I'm looking for a better trading opportunity, and I find it here in this short triple trender when they all 3 come into alignment. Here again, pull back into the short-term trender for our entry, and we can either get out at the short-term trender, or on a fast chart like this. This is again a 500 tick chart. It's more than 1 bar a minute, really. You could also I generally use the long-term trender as my stop loss in a trade like that. Now we can combine the triple trender with the trend strength index to help us stay out of trouble when the trend is not very strong. Remember, the triple trender is only showing us orientation of the trend and not really showing us the strength of the trend. The trend strength index is doing both, but it's more diligently showing us the strength of the trend. So when we put them together, we have some really powerful analysis that keeps us out of trades we don't want to be in. For example, this right here where we were looking at a moment ago, where the 3 trenders turned bearish, you can see the trend strength index was still bullish, albeit weak. It was not confirmed bearish trend. So I don't like to trade when the trend is not confirmed very strong. Here you can see the trend strength is really weak all the way through here. In fact, here, even though it's pointing up, it crosses the 0 line pointing pink. To me, that is my indication that I'm looking for a trend reversal to the downside, and that's why I'm so happy to see these 3 trenders turn red right there. I simply wait for 1 more bar for the Radar 3 to turn bearish, and I can enter my short position. And again, as I said, I can use my long-term trender on a fast chart like this. I use the long-term trender as my stop loss. If this was a daily chart, I might use my short-term or medium-term trender as my stop loss. A few more examples. You can see all three trenders come into alignment here with confirmed bullish opportunity. We see the pullback into the short-term trender. We stay in the trade until the short-term trender is broken. Here they're all in alignment again. We re-enter long and stay in until the short term or the medium term or the long term are broken on this bar right here. Now you can see we have all three bearish trenders above the price, but the Radar 3 trend strength is going to keep us out of going short, and that short, it would have been down here, so that really is not something we're interested in. So we're just going to stand aside. We could then, where is it? On this bar right here, of course, all the trenders got broken, and you could go bearish. I'll go bullish. I myself don't like to see these open gaps. I'm looking more for a pullback and interlong or a bearish signal here, which finally came about right here on this bar. All three trenders came into alignment, and the trend strength is confirmed bearish, and the short-term trender is broken on that bar. We have some more chop here. We have bullish triple trender but bearish trend strength. Here we have bearish triple trender but bullish trend strength. No really good trading opportunities until all three trenders come into alignment here, and Radar 3 turns blue. Somewhere around here would be your entry opportunity for this triple trender trade. You can exit on the short or medium term trender here, or use the long term trender as your stop loss. Now we can combine the analysis of the Radar 3 trend strength index and the Arps triple trender with some typical wave count analysis. And you guessed it, yes, we do happen to have a wave counter tool in our toolbox. This is the Arps wave count up, and it will identify the waves in real time as it identifies them. And we have wave count down. It's also a 5-wave pattern with a 3-wave reversal pattern. So you can see at the time this chart was made in mid-June, it had identified that we had completed a 1, 2, 3, 4, 5 ABC up wave pattern, and we were in fact starting a new up wave 1. Now this tool is a dynamic tool. It doesn't fix the wave count until the end of the wave pattern. So if the price does something to nullify the analysis of the wave count tool will follow the price and adjust its perception of the wave that you're in. We can use this tool in conjunction with the triple trender and the Radar 3 trend strength and the Radar 1 fear greed indicator to help us identify early entry opportunities. In this case, we see we had completed wave 2, we were beginning to identify wave 3 when we saw this triple trender buy signal, and by the time the triple trender buy signal had occurred, we had crossed the Radar 3, had crossed the zero line with a bullish indication. And I wanted to show you one other way I confirm an early trend entry, and that is I used a little alert setting on the Radar 1 fear greed indicator, and I set it to the value of the previous high of the indicator, and that way I have to wait for the fear greed indicator to exceed that value in order for me to confirm that the buying pressure is getting stronger than it had been in the past, that we're actually likely to see the potential for a trend there. So again, we're using the wave counts tool, we're using the Radar 1 alert aspect right here, Radar 3 trend strength confirming the triple trender entry for this long trade. Now, I have mentioned several times that I prefer to day trade. I actually day trade almost every day, and I don't trade with 15-minute chart or 1-minute chart or 3-minute chart. I don't like minute charts very much, especially for my preferred securities, which are index future contracts. So I use volume charts, and you can see I've listed here 3 different types of volume charts and 1 tick chart that I use in my everyday trading. And just for those of you that don't know what a volume chart is, a 100,000 share volume chart is a chart that requires 100,000 shares of whatever it is to change hands in order to draw each bar. And so each bar identifies 100,000 shares of volume. And so this is a 50,000 share chart and a 20,000 share chart, as opposed to a 610 tick chart, which is actually a very fast chart. A tick chart is not looking at volume; it's looking at how many trades occurred. And so a 610 tick chart requires 610 trades to occur. Doesn't matter how much volume those trades used, just 610 trades per bar. I don't have those charts in front of me, and I don't really want to go into describing the bull flag. We all know what a bull flag is, and we have a tool that will identify it. Here's a bear flag, and we have a tool that will identify that as well. So just to review quickly, some of the setups that we've been talking about here this afternoon are pivot divergence setups that look for imminent price reversals, and pullback divergence setups that look for imminent resumptions of a trend. And then we look for trend exhaustion 1, overbought, oversold signals. Those are especially good when combined with the pullback 23, and combined they give us what we call a trend exhaustion 1, 2, 3. The pullback 23 is a good signal for a trending market. And if I want to identify early trend opportunities, I can use the triple trender or the wave counts and combine those with radar 1 fear greed indicator or the radar 3 trend strength index. And of course I always use my radar 2 price leader as my timing tool. And the best exits for my trading are using the radar 2 price leader to identify acceleration and deceleration for quick exit opportunities, and I use the triple trender or some type of trender as a trailing stop usually to exit my positions. Real briefly, I don't want to go deeply into it, but for those of you using TradeStation multi-charts and very soon to be released eSignal, we have created some tools that will identify on a spreadsheet some of these setups, and this makes identifying setups on a large list of stocks or scanning for setups on a universe of stocks a lot easier. You can see we have tools that identify auto divergence setups, triple trender setups, trend exhaustion 1 setup, pullback 23 setups. We have others also, flag setups and all kinds of divergence setups and a lot of other different types of spreadsheet tools, which we call scanning tools. Most of these tools will show you how many bars ago a certain signal occurred and what the percent change has been since that signal occurred. They are color coded. Green means it was a bullish signal, and red means it was a bearish signal. And sometimes you have different colors of green and red that mean different things for different tools. I'm not going to go into the depths of each of these tools, but just wanted to show you that we do have these scanners available. In this case, I'm looking at a TradeStation radar screen, and I have the entire S&P 500 applied to it, and I sorted on the bars ago for auto divergence signals, and you can see I have quite a few divergence signals that have shown up in the last 1 to 6 bars. So that's pretty much what I wanted to show you. Feel free to contact us, info@janarps.com, if you have any questions about any of these tools. There's a bunch of other videos on our videos tab on our homepage, janarps.com. Make sure you sign up to see and read our weekly blog that uses these tools and these setups to identify equities trading opportunities, and we show you some of that analysis every week. That's go to the blog part of our website and sign up for Hawk's Scan Century Report. Or just make sure you go to our free stuff tab, and there is a free universal swing tool that is available to everyone. You can just download it. You don't have to buy anything. Just download it and it will show you the measurement of every swing. You get to identify how sensitive the swing is. It'll even show you what the price point for the next swing confirmation pivot is, and it's free. It's a great tool for analyzing and measuring swings. So I want to take this opportunity while I have your attention just to say thank you once again for spending some time with us here at Jan Arps Traders Toolbox, learning some of our setups and some of our tools. I hope that you've got something good from this little presentation. And again, if you have any questions, contact us. And until the next time, I wish you all the best in your trading and in your life. This is Hawk Arps signing off.